deducted at source, one of the most important component of income tax provisions. This is treated as the tax collection by the deductor to pay to the credit of the government on behalf of the deductee, means the person who pays the tax some amounts to the another person. He has to make a deduction of some portion, maybe 10%, 5%, 1%, depending upon the nature of transaction, recipient status, and mode of payment. So that payment has to be deducted by the payee and paid to the credit of the central government on behalf of the payee, means the person who receives the amount. So this is the most important provision introduced in the part of the Income Tax Act. With this, the government knows who is the payer and who is the recipient, what is the nature of transaction, how much amount is paid, and how it is paid. And the payee's tax liability, means the recipient's tax liability, is collected in advance so that it will not be a burden on the recipient at the year end. Just like advance tax collected, it is paid voluntarily by the recipient. Here it is collected in advance from the payments made to the recipient. So this is one method of collecting tax in advance by the government from the recipient. And what are the advantages of it? As stated earlier, it confirms the transaction between the payer and the recipient. It provides nature of transaction, which purpose the amount has been paid, when it was paid, how it is paid, and also it prevents tax evasion, means the recipient cannot escape from the tax liability because tax was already collected, and he invariably has to disclose the transaction, both the recipient as well as the payer. The government gets collection throughout the year. If it is an advance tax, there are only 4 installments: June, September, December, March. Whereas in the case of TDS, every month the payer has to deduct tax payments made for the services taken or for another. Any payment depends upon the payments made and mode of payment. How it is done? That is the process. The payer of the amount deducts some percentage of payment to the recipient, and that he will pay to the credit of the central government within 7 days from the date of from the end of the month in which it was deducted. And the payer will file his return of income mentioning the recipient's name and address, his PAN number, and how much amount has been deducted, so that the recipient can claim the TDS amount in his return of income as credit. Means he need not pay tax, means whatever the amount deducted by the payer will be adjusted against the tax liability of the recipient. So this is the benefit and this is the process. And in the case of government payments, the government is the payer. The government adjustments will be made through pay and accounts department through adjustment entries. So there is no actual cash flow transfer from government to the recipient. So in that case, the government will make the TDS and issue certificate to the recipient, maybe for salaries, maybe for interest, or any services received. That process will be done by the treasury officer or pay and accounts department or disbursing officer, and he will take the responsibility to make deduction from the payment, and he will make the payment credit to the central government and see that the return has been filed according to the due dates prescribed. Is it mandatory? Means TDS is mandatory. Yes, according to income tax provisions, TDS is mandatory. Every payer has to deduct tax from the recipient, amounts paid to the recipient, and he has to make the said amount to make the payment to the credit of the central government, and he has to file his TDS returns on time and issue certificate to the recipient. So TDS is mandatory. No payer can escape from the provisions of TDS. Of course, there may be a lenient view if the tax has already been collected and tax has been paid by the recipient voluntarily, but the responsibility of the deductor will not be escaped. So the TDS, the payer has to be more careful while making payment, and he has, for the purpose of TDS, filing returns and also issuing certificates. And what is the amount to be? Everything, this TDS depends upon As stated earlier, the TDS depends upon the nature of transaction, the amounts paid, the recipient status, then the percentage will be prescribed on the amounts payable to the recipient. Then how it is paid? All the payments has made by the deductor through digital payment only, and he has to file his returns of income digitally and issue certificate also digitally, downloading the certificate from the income tax portal. And if there is a delay by the payer in deducting the tax, he has to pay interest. And if the delay in payment of the tax already collected, means TDS made, there is a penal interest, means late interest is there. And if there is a delay in filing the returns, there is a late fees. And if it is more delay is there is a possibility of penalty and prosecution proceedings also for default in filing, default in making TDS, paying credit to the government, filing returns, issuing certificates. So this, when the deductor has deducted the amount and not paid to the central government, means it becomes a statutory liability to the government. So the government can take any action as from the deductor, so that it is the government's money, it has to be paid to the credit of the central government. Once deduction has been made by the deductor, means he has to make credit to the central government, otherwise he will be held responsible. Next, when TDS is applicable, when it is not applicable. Let us see where it is, when TDS is not applicable. In what circumstances TDS provisions, means deducting the amount from the payments made to recipient, is not applicable. When the amounts paid to government, means central government or state government or Reserve Bank of India, for way of any challans or any payment specified by the central government, that can be, there is no deduction. Interest also, it is not deductible. And amount paid to mutual funds. And next, when the deductee, means the person who is the recipient, obtains a certificate from the department that no amount, there need not be any deduction of tax based on his income, his source of income or his nature of business, then he can obtain a certificate from the department that no deduction to be made or lower deduction of tax. Then in such circumstances, TDS provisions are not applicable, and the payer need not deduct any amount from the amounts paid to the recipient. Next is, any amount is liable to be paid to central government or state government, maybe towards loan repayment or taxes or cess or anything, and any financial transactions also, there need not be any TDS to be made. Interest paid to the bank or banking company. If any person pays interest to the bank, he need not make any deduction, because banking company is collecting interest, and banking company will, this is clear provision that any person who pays amounts to the banks and banking company, life insurance, unit trust of India, national savings certificates, all these things, the interest payer need not deduct tax. Means the person who pays the amounts to the person is paying LIC premiums, he need not make TDS. The same person deposits in the unit trust of India, he need not make TDS. The same way, any interest paid to the bank or charges paid, no TDS needs to be made. And any contribution to national savings certificates, Kisan Vikas Patras, non-registered external accounts, banking or cooperative society, and savings account recurrent deposits of banks and cooperative society, and any other notified agency for which provision deductions, TDS provisions are not applicable as prescribed by the central government. So all the above transactions doesn't need compliance of TDS provisions by the payer, since the recipient is either central government or bank or authorized corporation, notified agency, notified authority or mutual funds. So the payer need not make any TDS. Next, how it is paid, how the TDS is to be paid. Earlier we have seen when it is applicable, when it is not applicable, and how it is to be paid. Then what is required to make TDS. Every person, every payer who has liability to make TDS has to obtain TAN number, tax deduction account number. On that basis only, he can collect the tax from the deductee or from the recipient. Then only he can make deduction from the payments made to the payee. And also, TAN number is mandatory to file TDS returns and to issue certificates for TDS made. TAN number is different from PAN number. PAN number is required for all taxpayers, whereas TAN number is required only for the people who are liable to make deduction from the payments made to the recipient after some transactions. I stated earlier, every deductor has to issue a certificate to the deductee after filing his returns of income, and he has to download and issue certificates to the deductee. And all the details of deductions made, TDS made by the payer and on behalf of whom the tax has been paid, means the recipient, details are available in Form 26A. It is in the portal of the Income Tax Department. So, details are verifiable by the payee so that he can verify the amounts deducted from his payment has been credited to the government or not credited to his account or not. That can be verified by the payee, and he can, if it is required, he can claim for rectification by the payer. Payee cannot do rectification, only payer has to make the rectification if it is required. Provisions which prescribes the amounts, which nature of amounts, means what payments needs to be applied for TDS purposes. So, all the deductors has to know in advance the nature of transactions on which TDS has to be made. It is the liability of every person who makes payment or the deductor or anyone deals with the commercial transactions or accounting transactions. Act says if any payments made or amount credited to the account of the recipient, the TDS has to be made. They cannot say that amount is credited but the amount is not paid, cannot be an excuse for the deductor. So, which is earlier, if the payment is made or amount is credited, that will be liable for TDS compliance. So, there are some exemptions. TDS need not be made even if such payments are there. That is, individuals who file 15G, means those who are having only agriculture income exempt from tax, they can file with the payer that I am not liable to pay tax, hence you need not make deduction from my payment. Means farmers may be or some other person who doesn't have taxable income, they can file a declaration with the payer that no deduction needs to be made. And for senior citizens also, there are some exemptions there. If the senior citizen income is taxable only some level, if they also can, if they are earning income from bank interest only, which is not liable, they can file a declaration under Form 15H so that the banker need not make TDS and the payments made or amounts interest credited to his account. And I stated earlier, TDS is applicable only if the payments are above the threshold limit. For everything there are limits are there. For salary different limit, contract different limits, so we will come to later, and percentage also we will discuss later. And what are the nature of payments covered under TDS provisions? That is salary, interest on securities, other interest also paid by anyone. Next, prize money from winnings, crossword puzzles, contractor payments, insurance commission, LIC maturity amount, brokerage or commission, transfer of immovable property, compensation and acquisition of immovable property, rent payment, commission payments, interest on bank deposits, remuneration paid to director of the company. All these are liable for TDS provisions. Means any person who pays for these transactions above the threshold limit, the payer has to make TDS from the payments made to the payee. Now let us go to the area where, now let us know how much tax is to be deducted, how much TDS has to be made from the payments payable to the payee recipient. If it is a salary, rates applicable based on his annual income, and premature withdrawal 10%, and if PAN number is not available, it is 20%, interest on securities 10%, 10% on interest on debentures, 10% on dividend income if it is more than the limit, and 10% other interest, 30% from winnings from lottery and crossword puzzles, 30% from winnings from horse race and jackpot, and 1% to payment of contractors, and it depends upon the status, and 5% on insurance commission, 5% on maturity life insurance policy, 10% on national savings certificate withdrawal, 20% on repurchase of units by mutual funds, 5% on commission on lottery tickets, 5% commission on brokerage, 10% on rent for land and building about 2,40,000, 2% on rent about 2,40,000, 1% on sale of property, 10% on royalty professional services, 10% on dividend income from shares and mutual funds, 10% compensation paid to acquisition of certain immovable property, 5% interest from infrastructure debit fund, 2% an amount of cash withdrawal from the bank, 1% payment made to e-commerce operator. So these are the percentages mentioned for which the payer has to make deduction from the payments made or payable to the recipient or deductee. All the above said nature of transactions covered under TDS provisions. Next comes when the deductor has to pay to the credit of the central government. Means what are the amount deducted from the deductee's payment or recipient payment, the amount has to be paid within 7 days from the end of the month in which the amount was created. If the amount is deducted in the month of April, he has to make the payment before 7th May of, means that is next month. The amount is deducted in May, he has to make the payment before 7th of June. Means all these due dates are say within 7 days from the end of the month in which the deduction has been made. So next stage is filing returns, TDS returns. The person who makes a deduction and he has paid to the credit of central government, the taxpayer has to make another compliance, that is he has to file his TDS returns quarterly to the income tax department digitally. For first quarter, April to June before 31st July, second quarter, July to September, 31st October, for third quarter, October to December before 31st January of next year, for fourth quarter, January to March before 31st May of the same year. Means all these returns has to be filed electronically, the dates mentioned before the due dates. And let us go to what are the consequences if the delay is made, means deduction, payment, filing returns, or no deduction. So for non-deduction of TDS, the deductor, the consequences if the TDS is not deducted, though it is applicable, though it is liable, will not be accepted as expenditure in the income of the payer. Suppose a person has a payment to a contractor of rupees 1 lakh. He has to make a TDS of 10%, 1% or anything like that. If he has not made TDS of 1%, then an entire 1 lakh will be added to the income of the payer. Means he will not be eligible to claim the expenditure as deduct from the tax liability. Suppose it has to be deducted within this month. If it is not deducted in this month and it is deducted the next month or 1 or 2 months, the payment has been made but deduction has been made late. For that, the deductor has to pay 1% every month for the delay. And if it is deducted and not paid to the credit of the central government, he has to pay 1.5% every month for the delay in payment of credit to the central government. And if there is a delay in filing the returns, means you have made the TDS, paid to the credit of central government, but you have not filed the TDS returns according to due dates. Then for every day, the liability of 200 rupees per day. Means if it is a month, 1 month delay means 6,000 rupees, 30 into 200, it comes to 6,000 rupees. So for every return, deductor has to pay a late fee of rupees 200 per day. And if the deductor fails to file his returns, totally has not filed the returns, he is liable for penalty up to rupees 10,000 to 1 lakh. It is for every return. It is not totally. So all these things imposes most responsible and accountability on the part of the payer to make deduction from the payments made to the deductee or recipient and pay to the credit of the central government within due date, means within 7 days from the end of the month in which it was deducted, and file TDS returns quarterly, and to issue certificate to the deductee as per provisions. If it is not liable, if he has not done, if there is a delay or default in any of the procedure, the deductor is liable to pay late interest, penalty, late fees. So all these things, the payer has to be more careful to comply. Otherwise, they are personally responsible. You cannot say that the company is responsible or the government is responsible. All the disbursing officers, all the financial officers who deal with the finance transactions are liable personally to comply with the TDS provisions. So this is with regarding TDS. So TDS is nothing but advance tax collection from the recipient through the payer, so that the TDS amount can be adjusted against the tax liability of the recipient. The TDS made is more than the tax liability of the recipient. The amount will be refunded to the recipient. If it is less than that, the recipient has to pay the balance while filing his return of income as self-assessment. And if he is more liable, the recipient can pay advance tax also in addition to TDS made by the deductor. So these are the provisions with regarding the payers has to be careful, for which they are more responsible, accountable and liable to comply with the provisions, TDS provisions, and with regarding issuing certificates to the deductee, the recipient. Thank you.